Hello, active traders. I'm Ken Calhoun from TradeMastery.com, and I'm pleased to be joined by my longtime colleague, Dr. Barry Burns from www.topdogtrading.com. Barry, it's great to have you with us here today.
Thank you, Ken. It's great to be here.
Let me go ahead and turn it over. Barry's going to talk first for the first half hour, and then I'll bring up the last half hour. And Barry, you don't have to stick around for mine. I know you're busy, and a lot of fire there in California, so got to stay safe. Let me go ahead and turn this over to you, and you should be ready to go. Here we go.
There we go. Okay, let me, let's see how to show my screen. Haven't used GoToWebinar for a while. Oh, there it is. Okay, hold on. All right, let me see, make sure I get the right one. Okay, monitor one. I've got two monitors. So.
Looks good.
Looks good?
Looks great.
Okay, good, yay. All right, well, thank you, Ken. Welcome, everybody. Thrilled to be here today. My part of the presentation is going to talk about how to trade pure price action. For those of you who don't know me very well, I'm the author of Trend Trading for Dummies. I receive Reader's Choice Awards from Stocks Commodities Magazine every year. I've helped other authors with their books, work with some big companies out there, as you can see. Well, my scaling's off a little bit with some of these. I've got a podcast too, so got a lot of free stuff out there. Feel free to check out my podcast wherever podcasts are. I am there. And this is a little bit of an old slide. I haven't really tracked where we rate right now, but at the time that they took the screen capture for me, we were number 10 in the investing world for podcasts on iTunes. So evidently someone out there is enjoying it. Here's our very important disclaimer, and I'll let you read through that. I just want to comment as you're reading through that so often we just overlook these legal disclaimers as legalese. We just poo-poo it, say, oh, that's not important. This is very important. I want you to think of this as education, because that's really what it is. This is where your education begins. Listen, the regulators have no hype. Right? There's a lot of hype out there in the marketing world of trading. And so you got to be very careful, and the regulators have done you a tremendous service by actually going out there, doing the research and saying, okay, here, my friends, is the truth about trading without any hype, all of it stripped away. So I encourage you to read those regulatory statements. I've got them on my website. Ken's got them on his website. So if you want to read longer versions, I actually encourage you to do that. Now, let's start with just some basic things about price action. I've only got about 25 minutes here. So we're going to go through the beginning stuff pretty fast. Actually, it's going to be a fast moving presentation here. So hold on to your seats, and here we go. Pay attention, because I'm going to go fast, like I said. So when it comes to price bars, I look at this as a very one bar, and this is what I call one bar price logic. Now, one bar is not going to make you money, but it helps you to at least identify the supply, demand, the sentiment of the market during that period of time. Let's say this, I think this is a daily bar, as I recall. So for that day, it was a bullish day. We opened at the low, we closed near the high. It's a wide range bar. Conversely, bearish bar. Wide range bar, open at the high, close near the low. So for that period of time, whether it's a day, 5 minutes, 100 ticks, whatever, that's a very, very small little bearish sentiment that's indicated. Now, this is also a bearish bar. Notice that the real body is green. I did that very intentionally because I found one of the things that trips up traders is they have this green-red switch in their brain, and they think, oh, if the candlestick is green, it's bullish, and that's not necessarily true. The real important part of this is we've got that long wick on the top. So we've got a wide range bar from high to low, and then we've got a narrow range real body, the green part, and we've got that long wick up on the top. So what that literally means is during this period of time, again, let's just assume it's a daily bar, the market during the bid auction of the 6.5 hours of the stock market tested all these prices. And when all was said and done, at the end of the day, after all the news, the rumors, the gossip, the spokesholes said all their stuff on the financial networks, the market decided, market meaning all the market participants, no, you know what, we're rejecting all those higher prices. And we have determined that, in our opinion, the market is worth that price down at the lower part. So in market profile, they have a term for this. It's called rejection of value. And it means that those higher prices were rejected at the end of the day. So that means it's a bearish bar. Conversely, one bar bullish logic, again, wide or long wick on the bottom of the bar. Yeah, it's red, but it's not a real wide range bar. On the real body, and all those values on the lower part were rejected, therefore it is considered a 1 bar bullish pattern. 2 bar logic, this is a lot of people call it engulfing. I don't measure things to the penny, pepper, tick. I think there's a lot of noise in the market. So, but the green bar negates the red bar before it, and therefore it is a bullish 2 bar bullish pattern and similar 2 bar bearish pattern, because again, first bar green, yep, that's bullish, but the very next bar is even more bearish. So you see, people ask me, well, how long are these candlestick patterns good for? And I've even had people ask me, well, if I get a bullish candlestick pattern, like an engulfing pattern or something like that, how long will that trend last? And the underlying assumption of the question is misguided, because these do not set up trends necessarily. Now they may, but just having 1 or 2 candlestick patterns like this, 1 or 2 bar candlestick patterns, does not make a trend. Does not make a trend. Okay, here again, bearish pattern, green bar followed by a rejection of value to the upside, bearish. Bullish, red bar followed by rejection of value bar, bullish. All right, now, what happens if we get a wide range green bar and then we get a narrow range? And remember, we're looking at 2 things, the range from high to low and where the real body is and the range of that real body. So the first bar, very bullish, second bar, neutral. It's just neutral. Anything that's narrow range, I don't care if the real body is green, red, whatever, turquoise, it's just a matter of fact that if it's a very narrow range bar relative to the other bars on the chart, then it's neutral. The market's just kind of pausing, it's hesitating, there's uncertainty, there's no real commitment during that period of time. So the way that I read this is I say, well, we're still in bullish mode because the previous sentiment was bullish. Now this day, the market is just hesitating for a day. It doesn't change the sentiment of the previous bar. So if you look at this, and this is a really important point, by the way. Let's see. I don't know if you guys, let me bring up my laser beamer here. There you go. So this one here, as we come down to this low, a lot of people look at this and they will say, oh, okay, this bar invalidated the bar before it, and therefore that would give us a signal that we have a swing low. And that is not true. This is a thing you need to be careful of as a trader when you look at historical charts. It's called forward-looking bias, where we can see what happened afterwards because we're looking at a historical chart, and then we try to figure out how could I have caught this move up. There are many times when the markets make a move where there was no high probability indication before that move occurred. And so there was no way that you could have known that market was going to move up. So don't think that every move in the market is preceded by a high probability trade setup, because they are not. And nobody catches every move in the market. So as professional traders, what we're really doing is we're setting up rules where the odds are on our side. We have a high probability setup, and we wait for the market to align with those conditions. You might have heard the term making the market come to you. And that's what that means. And the rest of the time, don't have, and this is called trader's remorse, where the market goes up, you saw this and you're like, oh man, I should have taken that long. No, you should not have. Just because the market went up does not mean you should have taken that long. The only reason to take it long is if there was some sort of high probability trade set up here, and there wasn't, based on candlesticks at least, because neither one of these bars is wide range, and neither one of them are bullish or bearish. They're just both pretty neutral. Now here, yes, here we have an engulfing pattern. Boom. Here, again, kind of neutral, doji, but the bearish sentiment is just sustaining, and here we get engulfing. So yep, that has an indication as well. And by the way, just to be clear, I would never trade just based on these bars alone. This is one piece of evidence that I use in my trading. And the top dog trading methodology is we use 5 pieces of uncorrelated evidence of money flow. And that's what our whole system is based on. 5 pieces of uncorrelated evidence of money flow, because all that makes the markets go up and down, I tell you, it all comes down to one thing: supply demand. And for whatever reason, people say, well, why did the market go up? Why did the market go down? As a short-term trader, frankly, I don't give a mouse's left patootie, because I'm not going to normally know that until it's too late anyway. And sometimes it goes up on just rumors and gossip that aren't even true. It's an emotional knee-jerk reaction. But people come in and they buy, and that's demand. So for whatever reason, if there's more demand than supply, prices go up. If there's more supply than demand, prices go down. If it's pretty equal, then markets just kind of consolidate and chop around. So for short-term trading, which is mostly what I do some investing as well, and that's a whole different game. But for trading, I just want to see, okay, what are people actually doing in terms of making their commitments? Because I know when they put their money in there, they let money go out of their account, they're serious. They're committed. They're not dating, they're not engaged, they're married. And that is what I want to see. So, and this price bars, today we're just focused on the price bars part of it, or price action. We're going to go a little beyond price bars. So here, gap. Will the gap fill, or will it be a gap and go? That's the question. Well, it chops around a little bit. Market comes down, puts in a little swing low. Now look at this bar here. This one retests this low, rejects the lower value. And for that reason, I would say, whoops, it's probably going to fill the gap, because this bar retests that low on a rejection of value. These low prices, the market participants at that time, this is only a 5-minute bar, but they're saying, let's see, we'll test that. Oops, nope, couldn't get enough supply. And so buyers come in and close the gap. Same or similar thing here. We come up, we reach this high, retest that high. Now, when you come back to retest a high, don't think that it has to go up to this high and retest it. Again, there's a bit of noise in these highs and lows around support and resistance level, because you got people trading all different time frames. I got a 5-minute chart here. There's people trading a 100-tick chart. There's other people trading a 60-minute chart. Those levels, daily charts, they're all going to look a little different to different people on different time frames. And by the way, different time zones all around the world now, and different data speeds. So some people have really high, fast internet access, others have slow. The professionals, they got their servers right at the exchange floor. You and I don't. So there's going to be, support resistance levels are zones, not lines. All right, so as long as it comes into this zone and then we get our engulfing pattern, that's a very, very, very good signal that, oh, okay, sentiment right now is bearish, and then we just look for it to sustain. And I literally trade bar by bar, bar by bar. Here, we have a huge wide range bar. Talk about what wide range on both high to low and open to close. And now, would we expect this to continue? The answer is yes, because if we scale differently, we see we had resistance here. And this started below the low, closed above the high, wide range bar. But again, just the pattern in itself doesn't always help you. We had a wide range bearish bar here, But look, it closed at this support. And now it goes a little below it, just enough probably to run some stops or take out some breakout traders and fake them out. But this one shows more strength because it closed above resistance and was a wide range bar. Okay, so volume logic. Let's add volume to the equation now. So we talked about price, and as I said, price bars is not enough, but it's one good piece of evidence. So now let's add volume to it. We want large volume versus small volume, enough volume, but not too much, and not just large volume, but we want smart volume. By smart volume, I mean professional participation, the smart money. So that is very, very, very important. So how do we determine whether the professionals are trading or the retailers are trading? So here's how I do it. I use a time and sales window. And whatever trading platform you have, you probably have a time and sales window. Just ask your provider if you're not sure, whoever provides you with charts, hey, do you guys have a time and sales window as part of my package? And they can guide you. Okay, but most trading platforms do. Don't confuse this with level 2 or level 3, by the way. Those are similar, but this is a little different. So what I do, and I set this up in a very specific way. So you got your timestamps, okay, the price. So the first thing I do is type. Now, type means what type of entry are they tracking here? So you could leave it, usually default will show you the bid, the ask, people are putting in orders for a bid or an ask. So I take those out, I uncheck those, and I only leave the trades. Again, why? Because actions speak louder than words. People putting in bids and asks that are not filled yet, that's words. That's words. I actually sat next to a guy. Oh man, this goes way, way, way back. He was an E-mini trader and a big one. He traded 100 contracts at a time. And I sat literally right next to him. And he was one of my teachers back in the day. And he would put these big orders in at a bid or an ask. Okay. And then as soon as the market would start to come to that level, to that price, he would pull the order. And that's called gaming the market. And I talked to him about it. I learned a lot about that day. And I started to understand, these bids and these asks can't always be trusted, because he intentionally put that in to deceive traders that there was a lot of demand at that level. And that was the game. That was the game. So now, again, he didn't cost him any money. And this is why, by the way, I don't know if you're familiar with this, but the government and has been in discussion for a long time about charging people for actually putting in bids or asks, that would have a commission even if it wasn't filled. And this is part of the reason why, because they knew about the game. So anyway, so I don't want to see what they're saying, right? Actions speak louder than words. I want to see the action. I want to see the commitment. Now, when they commit their money with big size, now again, if it's 1 or 2 contracts, they'll put those in. Those are called feelers. And they'll do that just to have some money in the game and get a feel for the market. So that doesn't mean anything to them. But when it's big contracts, like 50 contracts, okay, yeah, now they're serious. They're not playing around with 50 contracts. So that's what I want to see. I want to see the commitment of large money traders. And by the way, don't confuse this with the commitment of traders report. That's totally different. And that's, that's always late historical data. This is real time, tick by tick. I mean, look, you see all these orders here, within the same, second, right? So this is real time. And this is actually, well, the reason that you don't see too many is because of this. And I'll talk about this in a minute. So that's the first thing to edit. Okay. Actually, no, I do need to talk about that. So what I've done here is size. I will edit the size column as well. So how do we distinguish between retail traders and amateur traders? Well, retail traders in general don't have really big accounts, and therefore they're not trading a lot of contracts, or if you're a stock trader, shares, or if you're a forex trader, lots. So this is a futures example, but you could do the same thing with stocks, obviously. So we're looking at this and we're saying, okay, Does your average amateur trader, can they afford to trade 20 contracts on a consistent basis? And the answer is no. Can some of them? Yes. But can most of them? No. So the smart money is typically the people of the bigger accounts. So again, it's not a guarantee, but it's a really good indicator, really good indication. So I set this to show only trades where one trade, that's one executed trade. I'm not talking about sizing in or coming into the market and now they have a total of 20 contracts. No, one trade, 20 contracts. And I don't want to see anything less. So it's only showing me those trades and no other trades. Okay. Now, some trading platforms like TradeStation, I believe, yeah, TradeStation has this. This is, what do they call this? I forget what indicator it's called in there, but they will show you block volume. Actually, I think that's what it's called, block volume. And so you can put this at the bottom of your charts and you set this to, okay, how many contracts going through the market do you want to see? So you notice this is volume down here, but it looks different than your normal volume histogram because you don't have a bar of volume under every price bar. Why not? Because it's only going to show me the ones that had 20 contracts or more on a single executed trade. And that's pretty valuable. Look, boom, we had it come right in here. So this is a nice little trades setup here. Where did the pros come in? They came in early after a reversal. And that's typical of professional traders. They're getting in early before the amateurs. Now, they might have sized in as this continued to go up. That's not going to show here. Okay, and you got to also be careful. Remember I said you want good volume, but not too much volume. Just because there's big bars here, that does not mean they're coming in here. They might be getting out now. They might be getting out. Okay, you look over here and you can see. Now, here's one of the best things I ever came up with, and I can't believe I'm giving you this for free, but I am, and that's because Ken's a friend, and so I share some of my best stuff with his people.
Yeah, I'm loving this. I like this. I'm an expert tape reader, and I'm learning from you. This is really good stuff. This is advanced technique. So thanks, Barry. It's good stuff. Yeah.
Oh, well, thank you, Ken. Yeah, this is advanced. So volume logic, retail versus pros. So here's what I do. I bring up two time and sales windows. In the one, I filter it so that the size is 2 contracts or less. So that's where I see the retail volume. Then the other one, let's see, this time I did it 10 or more. Okay. And so, you could do what you want there. It depends on what market, and what would be considered, big orders for that market. Okay, so this one I set for 10 contracts or more. So now, set only one to show small size, show only one that shows the large size. So when you look at this, you got them side by side. Look, by the way, same price, 1205.75, all the way down the list. Same thing here, pretty much, 1205.75, a couple of 1205.50s. Okay, but all the 1205.75s, or most of them are green. Actually, all of them are green. The only one that's red is the 1205.50s. So looking at that, I mean, it's almost a rhetorical question. Would you rather go long or short when you see this disparity? Do you want to trade with the smart money or the, well, let's be polite, not as smart money? I mean, that's what this is. This is a X-ray into professional versus retailers and who's going in which direction. Wow, you don't see that on a chart.
And that's brilliant. This is really good. I learned from you. Thanks, Barry.
Oh, thank you. You're very welcome. My pleasure. Yeah, that's very powerful. Now, does that happen all the time? Of course not. It's not happening constantly. You wait for it. A big part of trading is to be patient. In fact, to quote myself, professionals outpatient amateurs. I think that's one of the biggest distinctions between amateur and professional traders. And I know this because, well, we all start out as amateurs. By the way, nothing derogatory about calling anyone an amateur trader. We all started out as amateurs, so I was too. But our goal is to help you go from amateur to professional, and that's why I'm giving you professional grade stuff here. So just want to be real clear about that. So that's one step. Now, if you want to take this even further, you can go, as far as you want with this. So here's in NinjaTrader, you can actually also, and I don't think TradeStation has this functionality in their time and sales, but NinjaTrader does. So you can actually have it colored different when they buy above the ask, or colored differently. So instead of just regular green, I've got mine lime green, or they sell below the bid. And so I make it magenta instead of red. It's kind of hard to see that there, but slightly different color. So that shows aggressive buying, aggressive selling. It shows maybe slippage if it's a fast moving market. And then I've set it to be a minimum of 20 contracts on that column. And then again, NinjaTrader is a little more flexible than TradeStation. And you can have another column here where it'll show block. And then block you can set for a different quantity of contracts. And so on this one, I set it for 50. So now I'm seeing 3 tiers. I'm seeing the amateur traders, like I showed you before. I'm showing you the higher level traders. And now I'm showing you and how does that compare with the people with really big accounts? And so, because we got some green in here, right? We got some green, more red than green, but we still got some green. But the people who are trading 50 contracts or more, 100% of those are red, and that pops up there just as a nice visual. Okay, now again, as I showed you the block volume in TradeStation, here's a great example. One of the bane of breakout, probably the bane of breakout traders, is false breakouts. Right? Happens a lot. It's annoying. We don't like it. So here's a little tool to help you out. So we've been in a channel this day. That's value area high. That's part of market profile, value area high and low between those 2 magenta lines. I love to have those on my chart. Yesterday's low, okay, very important, obviously. So we're just kind of tracking that. And by the way, yesterday's close is that gold line. So, all right, obviously just channeling. So great time to be looking for a breakout. When is that breakout going to happen? That's always the big question for breakouts. When? And the second question is, will it sustain? Will it follow through, or will it be a failed breakout? So bring in your little block volume indicator here, set it to whatever. Okay, now here, look, 2000. This is on the left. See, I put the scaling of this on the left so I can actually see the numbers. 2000. That's pretty bueno. That's a lot. And it comes right after the breakout. And so now you see 3 things: price level after consolidation to breakout, when, and is big volume buying or selling. I mean, my gosh, that is a super high probability way of mitigating dramatically your failed breakouts. So that's it. Here's what I got for you today to finish up. I've got nothing for sale, by the way, just a nice extra, actually several different things. So what I'm going to do is, for everybody here, I'd love to share with you one of my trade strategies, the whole thing, all the rules, the objective rules, and where you get in, where you get out, very specific. It's a 5-day video course, little mini course. Each video is about 15 or 20 minutes long. And on day 4, you actually get the rubber band trade strategy. It's based on a reversion to the mean mathematical model. And it's super reliable. The reason I give it away for free is because it has a super high win-loss ratio. So even for people who are not super advanced traders, I found that they can make money with this. And I love to give you lots of value in advance, so that, because I'm not a sales guy, I'm a trader. So I just educate my friends into my bigger courses. And I demonstrate that I can make you money by helping you make money before I ask for anything. And then if you don't want to buy my courses after that, and you just want to trade this, perfectly fine. You got my permission. Okay, whatever you want to do. But I find that most people, once I start making them some money with rubber band trade, they're like, oh, wow, I don't have to be convinced by a sales strategy. There's no hard close. It's like, the dude's making me money. I'm going to stick with this dude. And that's how I approach trading. So here's my email address, barry@topdogtrading.com. And to get this free gift. You just go to rubberbandtrade.com, fill out the little form there, and you'll get the first video right away today. You get the next 4 over the next 4 days. Rubber band trade will be on day 4. And if you have any questions about this trade or anything else in the little mini course or anything else at all, you've got my direct email address right there, barry@topdogtrading.com. So, boom, 2:30. Nailed it to the minute.
You got it, man. Thanks. Yeah, thanks so much, Barry. I highly recommend Barry Burns. He's one of the top guys out there from topdogtrading.com. And I learned a lot myself. I like the idea of professional versus retail volume. And that filtering is brilliant. I didn't even come up with that. I've never heard that before, but it's a smart way to look at the difference between block trades versus the signal versus the noise. And you want to get in on good breakouts. And that's a really smart idea you came up with. So kudos to Barry Burns. I really appreciate it.
Well, thank you. You know, it's interesting because I did come up with that on my own, and but I'm always concerned that someone's going to say, "Oh, you know, Jimmy John came up with that over at Penny Stocks Emporium," and I'm like, "Oh, really? Okay," because there's nothing new, you know, under the sun, like they say. And so I invented that, I think, but you know how it is. As soon as you think you got something unique, then somebody else comes out and says, "Oh no, there's someone else who taught that too." So, but it's really dramatically helped my trading, and I hope it helps everyone.
Yeah, you've got a very consistent, very logical, very easy to understand, and very intelligent kind of internal integrity, internal consistency approach in your YouTube videos and all your training. And it's very helpful. It helps me too gain clarity for entries and exits and the logic of how to approach your trading. Yeah, I think that's the best thing I get from you, Barry, is the logic and the intelligence of how to approach your trades based on various patterns and the rest of it. So very helpful. You're one of the good guys, one of the best out there. So thanks so much for being here. I appreciate it.
Thank you, Ken. My pleasure, and thanks for the invitation.
All right, well, thanks. And you guys be sure to hop on over to topdogtrading.com, get involved with Dr. Barry Burns. He's a longtime colleague and friend, and stay safe out there, my friend. It's fire in California, so be safe, and hopefully we'll follow up and do another one of these shindigs at some point in the near future. So appreciate it.
Great. I hope so. You stay safe too.
Thanks. All right, traders. Well, we're going to flip over to my presentation, and that was good. I actually picked up some really good tips that I can use. Can everyone see this presentation? Can everyone see this video and charts? Just doing a quick technical check here. Is it coming through okay? Don't everybody talk at once. Can everyone see my charts? Just wanted to make sure. Take a look at this market. I bought this today at 2380. This was my long trigger for S triple Qs. I sold it up here at the 2560 and had some sells up here as well. We're going to go over price action trading, and I'm going to piggyback on Barry's presentation to do a little bit of tape reading too, but just to show you what quick thing to minimize your cost of screwing up in your trades. Do what I do. Trade small. This is my actual order book of my actual trades today, and this is very typical for me. I do dozens of trades a day. I'm profitable on the day just a bit, but I trade odd lots under 100 shares at a time, mostly inverse instruments today. And you can see I sold. I'm a price action kind of guy myself. I sold SQs up at 26.24, so I sold the frickin' top. So pretty fun stuff. Anyway. And if you look at the tape, by the way, you got to learn the tape. And I'm pleased to see Barry's presentation on the tape. It's always good to have the time, the price, and the size at a minimum. And that way you can see actual order flow during live markets as things are starting to travel up or down. And you'll probably see some aftermarket plays here as well. So let's start by looking at price action trading setups and strategies. One of the first things, the main thing that you need to get at when it comes to price action trading is looking at clean, well-developed charts with good internal volatility, like Overstock is a good one, for example. Let me ask a quick question. How many of you are day traders? How many of you are swing traders? Or how many of you do a little bit of both? Because I can cover both for you. Overstock, talk about price action. This guy ran from 10 to 130, just under 130, and then a big epic fail. It formed this 50 SMA, By the way, these lines are not created out of thin air. This was derived from this. So it's not like it's testing a 50 SMA and bouncing because this was already there. I used to be a statistician at the Ford Motor Company. I'm an expert numbers guy. These data points formed the 50 SMA. But the point is, when you're in a good trade and you've got a good setup, it's always smart to scale in and look for wide ranges. That's the most important criteria for success in trading, is a wide trading range. Oh, wow, thanks. Thanks, Guillermo, Bob, Ethel, Daniel, another Bob, Dave, Dan. Looks like both swing, all good. Okay, good to see. So a lot of you do both. One thing to look at from a volumetric standpoint is recent high volume. That's kind of like a poker tell for those of you who, like me, like to play Hold'em. We have a large green volume, and this is UVXY. This is an inverse instrument that goes up when the market goes down. And I trade it daily, like I did successfully today, along with SQQQ is even better though. How many of you think the market's due for the mother of all sell-offs? I've been thinking so incorrectly since April. I just have been hard to believe that this rally has been going on in the face of global pandemic and bankruptcies and unemployment and all that kind of stuff. But hey, don't fight the Fed, don't fight the tape. So, but we may finally be at a tipping point. Bum, 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 bum. And the reason I can tell that is because we have a high volume on a green candles. And I like that what Barry teaches dovetails with what I teach as well. Always listen to what smart people say and then look at where the overlap is and test it out. Anyway, largest volume in 6 months in this instrument in SQQQ a few days back. Now, if it breaks each of these moving average lines, especially these two, I'm going to scale in and put on some size. This is where this thing was trading during the March sell-off. Look at the annual chart. Now, this is what I call a volume pivot. It may be due for a pivot. Now, how many of you agree that there might be some money to be made in these instruments? This is just one example of many. And we're going to take a look at these in just a second. Before I forget, let's do a quick introduction. Price action trading, all information is for educational use only. You may have seen me, I used to run Day Trading University. I changed my company name to Trade Mastery because I have a lot of swing traders. I also own Swing Trading University, but I want to simplify, so Trade Mastery. Anyway, I've been featured. Did any of you guys remember trading with Daytech back in the old days? 60-second, I don't know if there's they don't say it here, but it used to be they'd give you a 60-second order guarantee. Wow. Now it's instantaneous. But anyway, back in the day, I was featured all over the place. I'm a money show speaker. I'm frequently speaking at money show events around the world. I'm a real trader with tax return proof I really trade, which I think is kind of sort of important. And you may have seen me all over the known universe. Anyway, back to it. That's all the PowerPoints until the end. This is a sign that we may see an upside move. Now, I profitably traded SQQQ, just small size today. My goal is to build a swing trading position, and my technical trigger point is right near 30. And so from a price action standpoint, one thing that's really important, and I want you to remember this, is never buy anything with a 9 in it. So I know that sounds, you may have seen my stocks and commodities, my award-winning stocks and commodities articles. I want to buy this, but don't buy a 9, and because you want to avoid a false breakout. A 9, so for example, 29, 39, 49, you don't buy, but you buy over the 30. So I'm going to put on size in SQQQ if and only if it gets over 30 for a swing trade. And I frequently day trade it. I'm often day trading this in and out. And I bought this. Here's where I alerted my live trading room members at tradingtheopen.com. I said to go long at 23.8. And I know I recognize some familiar faces like Guillermo, hey man, and other people who've been with me in the live room. SQQQ, the long trigger, when it was down here, I said, go long, go west, young man. Go long if it gets over 23.8. Boom. And hopefully people can make more money than I did with my small trades. But still, I started scaling in there. Now, when it comes to managing entries and exits, one of the price action strategies you want to focus on is the decision as to whether to use trailing versus hard stops. Audience participation time. Do you guys use trailing stops, hard stops, or both? Type in the word trailing, hard, or both right now? I'd be interested to see. A lot of folks here, so it'd be good to see. Do you use trailing stops or hard stops or both? And yeah, you're right, Guillermo. Good point about September is historically a really bad month for the market. So it may be a really good time to be leveraging into these. Now, the problem with trailing stops are kind of like a double-edged sword. And the main objection, especially in swing trading, is they get you out of winning trades too soon. But for day traders, it's absolutely essential. You know, for example, I might buy here and then trail stop out here, then buy again here, do a regular stop out and lose a little money there, then buy up here and then sell into the pullback here with the trailing stop. Actually, I sold here. And I sold up there too. Anyway, the point is trailing stops protect you against V-shaped patterns. Well, actually, let's look at an example from today. My top stock pick for the day was Penn Gaming. I called it long for my members at 22.8. Now, how many of you, a lot of you, oh, it looks like both, okay. A lot of you, how to say, the challenge is that a lot of you may get your entries right, but you screw up your exits. Your success or failure as a trader is a function of both entries and exits. And I would say put more emphasis, the more skill, and the more millions of dollars worth of stocks and ETFs I trade over the last 21 years, the more emphasis I place on exits, because it's the exit that determines the profitability. I called exit for my members up near 64.5 today. Had I not done so, they might have stopped out, right? It's the difference between winning and losing, oftentimes. For example, Penn, I said to go long here. But did you listen? No. But if you listen, that's all well and fine, but you could have been a losing trade if you had sold down here. The sharper the angle of the breakout, the more susceptible it is to a reversal, right? So from a price action standpoint, you want to sell into whole numbers, especially after a spike up. And I called the exit for my members right here on this side of it at 64.5. And I said then to go short at 63.30 live. And it worked out for a nice move to the downside. The difference between success and failure is often attributed to your exit. So from a price action trading standpoint, you want to find charts that are in a nice uptrend. This one got on my radar today because it had a small gap up. This is pre-market, by the way. It's a 2-day, 1-minute chart with data starting at 5 a.m. East Coast time. Early bird gets the worm. If I had not seen all this data right here, I would not have been able to post this winning alert for my members in the live room here. Okay, and the exit up here near 65. I think it was 64.50, something like that. Always think about the whole numbers, and you may have seen my stocks and commodities article. We're looking at buying above a whole number and then selling into the nearest whole number. You see a good chart that illustrates that. Okay, yes, that was a good example. Price action trading. One thing to pay attention to is the previous day's open, high, low close, especially the closes, by the way, absolutely critical. And the whole number strategy from a price action trading standpoint is looking at buying slightly above a whole number. Okay, and so for example, SDOW, one could have got long at 18, 10, 20, 30, let it shake and bake all day, and then sell up at this would have been a good place to sell if you didn't feel like holding it into the close right under the nearest whole number, which is 19. So really what you want to do is look for trades within whole numbers, and that's something like one of those hidden word puzzles. It doesn't jump out to you immediately. You have to be shown what to look for. And it's always a smart idea to look for whole number breakouts. If we look, for example, at SQQQ, another thing to look at is buying off of previous day's lows. Now I jumped the gun a little bit. I got in anticipation at 23.8, and the reason that I called up for my members here when it was down here was I saw the volume was starting to pick up. You see the pickup in volume there? That broke out right after that 23.8, and the reason the volume, this is really important. Let me, two data points to look at. One is what goes on here, and the other is down here. When you see them, this is a quick tip to look for. What I want you to look for is the day's high volume bar. Where's the high? Now, normally it's on the open, but not during sell-offs, right? In this case, this guy sold off during the open, but I said to go long at 23.8 because the volume was starting to pick up, and because I know you buy the dip, sell the rip in the inverses. Barry had mentioned avoiding false breakouts, and that occurs routinely if you trade the inverse instruments like I do that go up when the market goes down. So you buy a pivot. Now, a quick tip is if you're looking for candle patterns is you may want to drop down to a 10 or 15-minute chart and see if you have evidence of hammers or bullish engulfings. That's a hammer right there, but it doesn't occur. Well, actually, I don't know if that's technically a hammer because it doesn't occur at the low. But at least we have some bullish lower shadows, and that's a start. This is a nice momentum candle. And again, this is kind of like a poker tell or clue, a hidden mystery clue. It's evidence that buyers are in charge. Now, usually what you see is a mean reversion pullback or a give back to support, then a resumption of the trend in this kind of chart. So we had a really good momentum breakout. I went long at 23.8. I bought right there this morning, and I sold up here with P&L proof. Small size, though. By the way, to build confidence in your trades and to give you bona fide, genuine experience that's useful, but hopefully doesn't produce large stop losses, start, or at least, or like me, continuing trade like what I call a Pac-Man approach. You know, like that old video game, Pac-Man, you're chewing these little dots of odd lots, 20, 50, 70, 100 shares at a time or whatnot. But do a lot of small trades. You nibble away at the market. So you're looking for these kind of patterns and you're trading, breakouts and pivots that make sense based on price action patterns that you know to look for. Okay, now that's a hammer. That's a red hammer. A hammer is a hammer is a hammer. That is an official hammer. So the long signal will be right above the hammer high. And for more on candlesticks, be sure to learn exclusively from my colleague Steve Nissen at candlecharts.com. He's brilliant, and he knows he's the world's top expert, and I'm deeply grateful to Steve for teaching me because it works. Anyway, so we got a hammer low, attitude confirming, it's not confirming support, but it occurs near previous day's support. So my thesis was that if we start to pivot off of the false breakdown, it'd be worth buying long, so I went long there. Anyway, those kind of charts are useful to help you develop a trading strategy or technique that makes sense. Now let's take a look at a couple of swing charts. Let's use the 90-day. I'm always using the S&P, the Spiders ETF, to validate entries and exits, and also to look for new patterns that make sense to trade. So you can see that when you see a BARC, little joke, big ass red candle, watch out below. But hey, we're just getting started. I fully expect us to get way down here, but I want to start scaling into, or I've been scaling into, I want to scale more aggressively into my inverses for swing trades because we have all these red candles. And one thing to look at is the ratio, like an air fuel carburetor, an old school car, air fuel ratio. Look at the red versus green candle ratio and look at it relative to major institutional moving average lines. I use the SMA, the 50, 100, and 200 simple moving average. This red line is your 50 SMA. That's the weakest signal, but it's the first one that will generate sell signals in the broad market. So if we lose 332 or so, we may see some continued downside in this. But more importantly to me is which of these is most green? S triple Q's, baby. So we got a nice bullish engulfment here. And if this recovers this SMA, I'm starting to build size. And my goal is to put in at least $50,000 to $70,000 worth of inverse ETFs, but not all SQs. I'll be building a portfolio. I'm already in a little bit, but I want to put in size of things like SQQQ, short the Dow, SDow, SPXS, and the rest of it. This is the first time I've seen volume this large in a very long time. So you're welcome. That's probably good for a huge run to the upside. Now, to get guidance on exactly, entry and exit support and resistance education on, and also real life trade examples for me with P&L proof, you may want to join my live trading room at tradingtheopen.com. That's where I'm focusing most of my energy now. I used to create courses all the time, and I've got dozens of courses. You can go to tradingvideos.com, www.tradingvideos.com, and that has a list of all my courses. That I own that URL, and that forwards to trademastery.com/instant-video-downloads. But anyway, when you're looking at pivots, you're looking for whether or not something's actually going to do the mother of all bounces and double my money and go from at least here to here. You know what my biggest challenge is going to be not taking profit too soon. And so what I want to do is a technique that one of my longtime, very smart room members, Richard, had said is building a core position. And so I want to start, because the volume is so compelling right now. I mean, look at it. The volume is just jumping off the page. Barry had talked about professional versus amateur volume, and that's a very smart concept. That's what we see here is potential professional volume. So for that reason, I'm going to be spending a lot of time continuing to trade the inverses if they go up, and you may want to join my live room for guidance and tips and ask questions in live markets. You can even get the live room for a whole year for just under 1K. But anyway, the point is, that's a price action signal. This is jumping off the frickin' page, and it's telling you, buy me. Okay. Now, there's always a price that proves a trade wrong. Because I've been faked out repeatedly trying to buy bounces and the inverses. But this time may be the charm because the professional volume is so much higher than the average retail volume during the downdraft, right? This was the March lows, and it was up at 150 a share. The volume has been pretty aggressive compared to back here. Look at the volume here is half as much. More volume here this last few months, and explosive volume right now. So from a price action trading standpoint, what you want to do is develop a plan for good breakouts that make sense. Okay, let's switch topics a little bit and look at the topic of, charts worth trading in the first place. Tesla started the day off green, but sold off later. Codex, really good. CODX, I traded this last week. I should have held, but hey, don't kick yourself for failing to hold and it runs up without you. That will happen for the rest of your and my life as traders. Is you'll be in a position, you'll close it out at break even or small win or small stop, and then it makes a big move after you. Does that sound familiar? After you get out, that's frustrating. Anyway, clean wide charts that are beating the market like CODX when the S&P is down is something I will be trading tomorrow if it meets my criteria. If it breaks out over 1280, over 13, it may make sense. DraftKings, I didn't trade it today, but my long trigger is 41.85. And if anyone took that, it ran up to the 42.5, 43, 44. That guy didn't go anywhere. The Pin Gaming sure did. One thing to look at when you're looking at an industry group, whether it's gold, like I like to trade GDX. I traded Dust today, but break even. I got in at 1680 and back out at 1680, so that one didn't do much for me. I thought it might have a little more to it. it looks like it finally did bounce right into the close there, inverse gold at 1730. But anyway, the point is you want to start by sifting through different stocks or ETFs that are in the same industry group or the same sector. So for chips, that would be things like AMD and Micron and Intel. For inverse instruments, we're looking to short the NASDAQ, and short the Qs, short the S&P, short the Dow, short small caps, play volatility, the VIX ETNs. But which of these is best? That one had the biggest upside price action in today's markets and certainly makes sense to follow up as well. So that's what we're looking at, those kind of charts. So I hope that makes sense. I know there's a lot more I could cover about price action. You may have seen my articles on tape reading and videos and the rest of it. But those are the type of charts that I like to focus my members on at the live room. But that was the specific trigger right there, 2380 today. And that was good. I made money with it. Not a lot, but at least I made money today. I want to make a lot by starting to scale in once they're still in kind of an indeterminate trying to bounce mode. When we get in a confirmed territory that we've got a 2-day high that closes. Kind of a last thought on swing trading from price action. You may have seen my recent stocks and commodities article. And remember this for the rest of your days as a trader. When it comes to swing trading, I make decisions at the end of the day, trading the close into the 3:30, 4 o'clock. Now, if we end up above, if the thing I'm trading ends above, this I won't count because it's about at, so it's not above. It poked its head up above, but if it had closed up at say 2660 or 2680, I'd keep size on or scale in into the close. If it closes in the previous day's range or at a resistance area or a support level, you hold it. So this is buy, this is sell, and I'm sorry, this is buy, this is hold, and down here is sell. If this thing had closed off down here, where it was earlier today, then I would not be swing trading overnight. So anyway, using that kind of a criteria relative to the previous day's high-low, does the instrument you're trading close at the high? If it does, you add more shares. Thou shalt buy between 3:30 and 4 if it ends the day up at a 2-day high up here. It didn't, but for charts that do, that's where you scale in. If you're swing trading and it closes inside the previous day's range, that's a hold signal, like those old analyst ratings that no one pays attention to. Buy, sell, and hold. This is much more useful because it's based on today's price action. And from a swing trading standpoint, if this had closed down here, I would scale out, like unwind half the position if it had closed the day down here. All right. But anyway, that's the kind of approach that I like to take in the markets, and hopefully it'll help you make some successful trades. We got to wrap up here. We're at the hour, and so I wanted to thank you for being here. Trading action plan, putting it all together. You might want to look at entry patterns to trade, stops, targets, and exit signals. Look at trading volatility and price action using some of the techniques I shared with you. My live room is at tradingopen.com. It's only $7 for a 3-week trial. It's $197 a month, but it's only $997 for a year. So that breaks down about like $87 a month. So the live room is only under 1K for a whole year or 300 hours of training. But to get started for free, you can go to trademastery.com and log into or register at the free members area, and you can get some PDFs of ebooks that I used to have on Amazon and some videos and the rest of it. So anyway, thanks for being here. I appreciate it. I know, Wayne, I'm not trading options right now. But good question. See, my violent objection to options is that you've got premium decay, which is an overhead cost, kind of like financial transaction tax, which will get passed if certain people get elected, which would not be good for active traders because it would kill day and swing trading. So I'm a price action guy. Well, I live and die off the tape. I'm always using the time and sales to see where things are headed. Tape reading is one thing that I cover for my live room members as well, we often break into tape reading activities. Now this is all kind of light yellow because it's aftermarket, but in market, these are green and red. You can see, Barry talked about block trades. I did the world's first tape reading seminar back in the year 2001, nearly 20 freaking years ago at the Sheraton Anaheim, right across the street on the north side of Disneyland, 2 decades ago. Anyway, so I teach traders how to look for blocks, how to look for price action entries based on volatile entry and exit patterns that we detect in the time and sales window. And again, this doesn't look like in market, this is green and red. Aftermarket, it's yellow, but it shows, and this is only real trades, like Barry had talked about too. These are only real trades. This does not show bids or asks or anything. These are actual transactions. And we look for blocks, like a 4,500 share block, that's some size. 500 shares, not so much. But if you have a large size, along with an increase in volume, an increase in price action, your time and sales window of the tape becomes especially useful. So we follow up with, and by the way, I don't know how many of you trade aftermarket or pre-market, but I frequently do. I don't think I'm going to trade today aftermarket, but we got a couple hours left in extended hours that you can still trade. So that's another time. The reason I mention that is, hint, that's another time at which you always want to have a large, easily visible tape in front of you so you can see what the current trend is in time and sales. So well, I'm going to wrap up. Thanks everyone for being here. I do appreciate it. You guys take care. If you're not yet part of my live room, it'd be great to have you as members at tradingtheopen.com. And be sure to get involved with Barry Burns. He's one of the good guys. He knows his stuff. He's smart. He's intelligent. What he says makes sense. I learned from him myself as well. So he's one of the good guys. I'm one of the good guys. Hopefully you'll agree with that. And wanted to wish you the best. So anyway, trade, again, price action is everything. Talking heads are nothing. Opinions are like noses. Everyone has one. All we care about is the money. Show me the money, right? So now 23.8 was a completely counterintuitive entry, but yet I took it, and that's where I bought because it was a pivot. I didn't wait for it to get up here. I didn't speculate and try and buy bounces on the down low. I bought into the biggest upside move early in the candle recovery pattern here. By the way, that's another quick tip. Last tip of the day, I promise, is look for a succession or a series, I should say, a sequence of at least 3 green candles in a row, 2 or 3 green 1-minute candles in a row, or for your swing trades. If you're trading something that has a nice big trading range, it makes sense. The final pattern, remember I taught you this, remember this. When it's up here, remember when I told you about it down here, all right? The other daily candle momentum pattern I want you to learn is small candle, large candle. You see a smaller candle followed by a larger whole row body candle. Here's a better pair right here, or even I do not like doji because it's undecided, but you see a small candle like this pair here, small whole row body candle followed by a large whole row body candle of at least twice the height of the candle body in a pre-existing uptrend, a long breakout above the second candle, in this case that'd be around 60 or so, is indicated. And when you start to see a reversal, like a bearish engulfing right here, whole row body wrapped around the previous body, this is a bearish reversal telling you to sell it all if it loses right there, which it did. And that would have got you out right in the nick of time near 110. So anyway, small whole row body, large whole row body, that pair is often a momentum pattern. This is a better example of that, small followed by large whole row body. All right, I'm going to wrap up. You guys take care, and I'll see you next time. Bye for now.